Welcome traders to another Tickmill trading update with me, Patrick Munley. Want to update the SP 500 view using the Emini futures front month continuous contract and identify some key action areas for the trading week ahead and look at some realistic price objectives above and below the market. So before we jump into the technical picture, as always, want to review where we are in terms of last week's performance, look at market breadth, take a look at volatility, and also take a look at the calendar for the week ahead and see where we are in terms of dealer positioning. So before I start, the quote obviously is ES1, that's the front month continuous futures contract. If you want to get the cash US 500 equivalent levels, you can subtract about 10 points to get the same levels in the spot cash market. So as I say, before we jump into the technicals, the S&P 500 was up 0.3% for the week after making an all-time high to start the month. For the year, the S&P is now up 10% and is just 0.8% from the current all-time high. In terms of sectors, financials and communication services also made new all-time highs. Healthcare and energy remain in correction territory after energy's weakness. In terms of the market condition, on the monthly time frame, we're one time framing higher, and that one time framing higher would be invalidated or neutralized by any breach of 62.39 on a closing basis. In terms of the weekly condition, last week was an outside week with a bullish close, which was over the midpoint for the week, but within the previous week's range. So this means that on a weekly scale, we are also in balance, 63, 62 to the downside, and to maintain or to develop a one-time framing up scenario, we need to see a close through 65.41. In terms of the daily candle or the daily condition, we had a close in negative territory on Friday, which was just under the midpoint of the previous day's candles. So that brings us also within a balanced scenario. So 64.52 on the upside and 65.41 on the upside, equivalent with the weekly balance high, and 64.52 is the downside invalidation for the daily one-time framing. The daily balance. So those are some key levels to bear in mind in terms of the market condition and market structure. Noteworthy as well that over the past 3 months, so through summer, June, July, and August, the low for the month was actually put in on the first day of the trading month. After the gap down to start the month, we did get that one-time framing higher in terms of the S&P until obviously Friday's price action. So we want to pay attention to see if this pattern continues. Obviously now we have a higher degree of participation and volume back in the market. So this could lead to more volatility, certainly, and we have plenty of catalysts for that this week. If we look at the market breadth, you can see that in terms of the current structure, S&P 500 stocks that are trading over their 20-day moving average. So this is a compilation of the 3 time frames that I track here. So the 20-day closed at 55% on Friday, which was down from 67% the week before. S&P stocks over their 50-day moving average closed at 58%, which again was down from last week's 63%. And the S&P 500 stocks trading over their 20-day moving average, 200-day moving average closed at 63%, down from 65. So all reads are still over the 50% mark, but it is notable that the 20 and 50-day moving averages have seen declines over the past 2 weeks, whilst the S&P has been continuing to make new all-time highs. So we are seeing a bit of divergence there, and we'll see if that divergence feeds through into a more material move to the downside with respect to the index level. In terms of the calendar for the week ahead, we have a potentially volatile data set in front of us. We get non-farm payrolls, annual revisions on Tuesday, inflation reads on Wednesday and Thursday. We also get 10 and 30-year auctions, treasury auctions. We want to keep an eye on those as they have a potential to be significant if we don't get decent demand in those auctions in terms of the bid to cover. The non-farm payrolls revisions will be interesting to see, to look if the administration wants to put in a lower watermark in terms of jobs data, and we get, like I say, PPI before CPI this time. And so that sets up CPI really as the focus for the week. No data of note today, Monday. In terms of where we are in the term structure for volatility going into the week, it shows here that you can see that whilst volatility remains low at the start of the week, we are expected to see an uptick in volatility heading into that CPI print into the back end of the week on Thursday, and we see that that uptick in volatility continues heading into to next week as well at the moment. So that's something to factor in here. And in terms of dealer positioning as we start the week, today dealers look poised for a gap higher to test 65.25 as the initial upside objective, and below us we have 64.25 is where hedging activity looks to be fairly significant and heavily supported really on the puts that are sold at 63.85 and lower. Heading into tomorrow, looks like dealers are positioning on the short side with a range of 65.50 to 6400, and this would most likely be the day that we attempt to make a move lower. And then heading into Wednesday with PPI data, lots of defensive hedged positioning for that. And Thursday, obviously, well hedged down to as low as 63.50. And then Friday, dealer short positions are in focus. For now, this looks to be potentially the most volatile day of the week, as I said, with that volatility rising through the back end of the week. So let's move to the technical picture in terms of where we are on the weekly time frame. We're still sitting at or around the yearly R1 and that 127 extension of our post-tariff announcement, post-Liberation Day announcement pullback. And so we continue to trade just below that 65.27 area. And the weekly volume weighted average price remains bullish at 64.09. And I would note that weekly projected range support versus market maker implied volatility is 64.07. So keep in mind that 64.09, 64.07 level if we do start to extend to the downside meaningfully. And then we have weekly range resistance 65.56, which coincides with the projected ascending trendline resistance on this potential wedge pattern that we'll talk about a little bit more in a second. And so those are some key levels to keep in mind in terms of the weekly range resistance and range support. I'm using a bull bear zone for the week to start the week at 64.40 to 64.50. Let's move to the trading time frame and see where we are here. So looking at today's open, what I'm anticipating is that we get a test up ultimately up into that 64.25 area. So any pullbacks to start the session this week that bring us back into the anchored weighted volume average price versus Friday's swing low. We have projected ascending trend channel support. So 64.80s would be my intraday bull bear zone to start the week. Any pullbacks there, look for bullish reversal patterns to engage on the long side. And what I'd like to see is this 65.20, 65.25 area get tested. And I would anticipate from there we could see a pullback to get a retest of our current resistance area at this 65.07 as support is maintained there. What I'd be looking for would be a drift higher up into our weekly projected range resistance. We've got some other components here. We have the 127 extension of Friday's decline. We have the 127 extension of the prior week's decline. So I'm looking at any move up into the 65.60s, 65 mid 65.50s, 65.60. I'll be watching for bearish reversal patterns there to engage on the short side, certainly heading into tomorrow's session. And I'd be looking then for a pullback to develop. First targets will obviously be the prior all-time highs here, 65.40s, but ultimately I think we could see a move back down into test the 65.20s, and then we would be looking to see, can we break this ascending trend channel support, and if we can, then we'll be looking for a move back down to test into our weekly bull bear zone at the 64.50s, 64.40s on the downside. The alternative scenario is that we gap higher here, and then we'd be looking for that move up into the 65.25 area. And again, watching for bearish reversal patterns there to get that move back down to test our daily bull bear zone into the 64.80s before looking to make that grind higher up into the weekly projected range resistance. This is my key potential reversal area really for the week. The other scenario would be that we don't hold the daily bull bear zone and we get an early test of the weekly bull bear zone. I would anticipate that on the first test there, we will see attempts from the bulls to run things higher, but then we'd be using the 64.80, 64.90 area as resistance to get a move down to test then weekly projected range support into the 6400 area. From there, I would once again be watching for bullish reversal patterns to play for at least a bounce back up into the bull bear zone from below, and then we'll see if sellers step in there. Then we could be thinking about a move to retest the prior week's lows at 63.70, 63.60 on the downside. So those are scenarios I'm looking at as we start the week. Obviously, I provide daily updates in through the Tickmill blog that you can track with daily projected setups in terms of trade levels and targets, which are issued at the London Open daily. As always, traders, plan the trade the plan, and most importantly, manage your risk. Until next time, thanks very much.